Sanjay Shah, Senior VP and Fund Manager, Head of Fixed Income at HSBC Global Asset Management, who joins in on the show. Sanjay, to start off with that crucial data point, the HSBC Services PMI data, that one falling below the crucial 50 mark in July. That suddenly dashed hopes of a quick turnaround for the economy. What really do you believe this is contingent on? And do you think that this once again puts the Reserve Bank in pause mode?
Yeah, see, as of now, economy is suffering because of a lot of policy decisions which are pending. And these policy decisions, making of these policy decisions is the way to go forward, and that is how economy will come back on track.
Trading your portfolio right now, because as we were discussing with Maithili, yeah, can you hear me, Sanjay?
Yeah, I can hear you.
Just wanted to understand from you, how are you really positioning your portfolio right now? Because not only have the yields suddenly shot up, they've become quite sticky around the 8% mark, threatening to be on the higher side as well on many sessions. So how are you positioning your portfolio right now? Because till recently, 2 weeks back, when the sudden sharp spike in yields was observed, we saw a lot of portfolios and NAVs almost dip sharply and even go into negative. So how have you rebalanced your portfolio right now?
So how we are looking at the portfolios currently is that the GSEC market is going to be very volatile, and one needs to be cautious on the very volatile segments. So as of now, we are focusing more on the medium term and the short term segments where the yields are substantially higher, and the benefit of accrual is quite substantial. In fact, as of now, a lot of demand from investor segments is coming in the segments like short-term plans, in the segments like fixed maturity plans and so on. So we are focusing on that segment where investors can actually lock in the higher yields which are there currently.
Sanjay, we've already got data showing that in the first quarter of the year, the government has already touched 48% of the fiscal deficit target for the entire year. So do you anticipate that the government will have to borrow more? As it is, I think with the elections coming up, they're bound to announce more populist measures, all of which doesn't speak very well for our chances of achieving the fiscal deficit target. Do you think this will spill over into more borrowing, and what does this mean for bond yields?
In fact, this quarter's fiscal deficit number is to be looked at in context to what happened in January to March quarter of last year. Because in that quarter, government was in saving the deficit mode, so there was a lot of spending that did not happen in that quarter. That spilled over to this one, the April to June quarter. That is really reason why the fiscal deficit is appearing much higher than even the last year's numbers and so on. And obviously, as you're saying, at about 48% of the entire year's estimate. But now going forward, we expect that this one quarter may be a better quarter, but after that, government will again start to tighten the fiscal numbers, and from October to March period, we'll see the government spending will be again on the downhill, and that will save the fiscal deficit numbers. It is very imperative for government to actually manage the fiscal deficit number, because a lot of rating agencies and everybody is looking at those numbers to look at the fiscal health of the country and eventually the rating of the country. So I don't think government will let these fiscal deficit numbers go down or slip in that sense. Bond yields, obviously, on the other hand, will suffer if the fiscal deficit were to go out of hand and the populist measures and so on. But as we have seen, some of the populist measures like the food security bill and so on, they are not going to have a substantial impact this year. They may perhaps have impact from next year onwards. That's why we expect that the populist measures are not going to hit us very badly for this year at least.
Absolutely, Sanjay. They will not hit us so badly this year, except that markets and rating agencies are always forward-looking, so I really do not know what that means for as far as our rating is concerned. But one question as far as bond yields and bank treasuries are concerned, I think banks have been asking Reserve Bank of India to increase the held-to-maturity portfolios, part of their portfolio. Is there really a case for this, and what will it mean? Will it help banks in any way, and to what extent?
See, basically, as we are talking about these yields moving up from about 755 to 825 levels, there is substantial loss that has piled up on the bank's AFS book. available for sale book. Some of that loss or in some way banks would want to park that in a HTM book, and that is why the demand for higher HTM and so on is coming up. Basically that will actually shore up banks' profitability for the quarter rather than actually helping them in substantial manner. So it is more of managing the profitability kind of measure for the banks.
As far as the inverted yield curve is concerned, there's been a sharp increase at the short end, quite over 11%. Do you think this is going to be a long-term feature, or is it only a very temporary thing?
It's really the question where how long RBI keeps up the fight of increasing rates against the currency. So as long as the fight of increasing rates against the currency goes on from RBI side, these rates will stay higher. And in fact, we feel that once RBI kind of goes back to a 7-quarter of overnight rate, these rates will not be available. So we are actually telling investors, and in fact ourselves also, locking in some of these rates of 11% plus into our books, which actually helps in the longer term. So it will be temporary, but no one knows, and it is not very good to speculate on when the measures will be off. We expect at least a couple of months these measures will stay in place, the liquidity measures.
Right. Sanjay, what kind of indicative yields are we talking about in your new product which you are launching for fixed maturity plans?
In fixed maturity plan, typically we don't indicate any yields as such. It is not allowed as per SEBI for us to kind of indicate yields. Having said that, about 980 to 10% on bank CD portfolio is what is available on individual CD basis. So that is something which investors can look to invest in. As of now, CDs are available to investors as well to invest in at those levels.
All right, Sanjay. Thanks a lot for joining us on the show today.